Good morning, Shri. Okay, students, as you do know that we were having a discussion as per Ifrs 9. In our last lecture, we started discussion for Ifrs 9. That is for accounting of financial instruments. Ifrs 9 is for financial instruments. I told you that financial instrument is any kind of an instrument which is an asset for one entity or one person and the liability or equity for the other entity. What is the basic definition of a financial instrument? It must be an asset for one entity and it must be a liability or an equity instrument for another entity. We started discussion for financial liabilities and we discussed about the recognition and accounting treatment of financial liabilities in our books of accounts. As you can recall the concept of recognition of financial liabilities, we discussed that we have to initially recognize the financial liabilities at their fair value and subsequently we are going to measure them at their amortized cost. And what is an amortized cost? Can anyone tell me? It is the balance at the start of the year plus effective rate of interest minus interest paid. With the passage of time, year to year, subsequently, we are going to measure the financial liabilities as per this principle. We are going to see the balance at the start of every year. We are going to add the effective rate of interest in that, and we are going to deduct the interest paid out of it, and we will be writing the balance at the end of the year in our SOFP. Together with that, we have discussed that the amount which we are going to write, which we are going to calculate in the effective rate of interest column will be charged as the finance cost in our SOPF. So this has been the basic principles for financial liabilities. Now we are going to extend the topic of financial liabilities today, and we will start our discussion by having a look at the preference shares. Preference shares are the one kinds of the shares in which the principle of substance over form does apply. Preference shares are those kind of the shares in which the priority will be given to the shareholders. There are basically two kinds of the shareholders for the limited liability companies. One kind is ordinary shareholders, which we do generally call as equity shareholders of the company. And the other one is preference shareholders. Whenever the dividend is distributed, the priority will be given to the preference shareholders. And normally, the dividend is going to be accumulated for the preference shareholders. If in 1 year, the dividend is not being given to the preference shareholders, in the next year, it is going to be accumulated. And together with the previous year dividend, current year dividend will also be given to the preference shareholders in accumulation. So whenever the distribution of the dividend is going to occur, every time the organization has to give a priority to the preference shareholders. Under preference shareholders, the concept of redeemable and irredeemable preference shares also does occur. Preference shares sometimes can be having the properties of both equity and liabilities. And it depends upon the types of the preference shares. If the preference share is a redeemable preference share, it's one of the kinds of the preference shares. If the preference share is a redeemable preference share, it means that at the time of issuing the shares to the general public, the company has promised the public that at the end of the certain time period, we are going to return the amount taken on the behalf of these shares. Redeemable means redemption. This word has been derived from the word redemption. Redemption means return. So redeemable preference shares are those shares for which the entity promises the general public at the time of issuing the shares that at the end of the fixed time interval, we are going to return the amount back to you. And this is the general property of debt. This is not the property of shares. That is why when the redeemable preference shares are going to be under consideration, we are going to consider them as our liability. These are obviously our financial instrument, and redeemable preference shares will be considered as a liability if they have to be redeemed, they have to be returned. And since they are having the properties of the liabilities, we are going to account them for as per our non-current liabilities. We are not going to consider them as our shares. We are not going to write them and recognize them as equity, but we are going to consider them as the non-current liability. So financial instrument, debt instrument will be one of these redeemable preference shares as well. Clear, Dr. Tim? Now, the return on the redeemable preference shares, obviously for the preference shares, the return which we have to give is known as a dividend. But in the case of the redeemable preference shares, since the return is being promised, it is being must to pay. That is why it's again a characteristic of a liability. Interest is promised, but dividend is never promised. Since on the redeemable preference shares, the dividend is being promised that it is must to be paid. That is why again the characteristic of the debt is being applied. So the dividend which we are going to pay on the redeemable preference shares will also be classified as the finance cost. So its economic substance is that of a debt. Its legal form is that of a share, but still we have to give a priority to the economic substance. So for redeemable preference shares, keep in mind that you have to consider them as your non-current liability, and the dividend which you have to pay on the redeemable preference shares will be considered as your finance cost. On the other hand, we have irredeemable preference shares as well, which are going to have the normal characteristics of the equity, and we are going to consider them, we are going to recognize them as per our normal equity, since at the time of inception, since at the time of issuing those irredeemable preference shares, there is no promise to pay back the principal amount as well as the dividend. So this is the characteristic of the normal equity instruments. So that is why we are going to classify them as equity in our books of accounts. Now let's have a look at your book, what your book says about this. The book says if irredeemable preference shares contains no obligation to make any payment, either of capital or dividend, they are classified as equity. So in the simple statement, they have told you that if in irredeemable preference shares, there is no obligation to pay back the amount of the principal or the amount of the dividend, we are simply going to classify them as equity, because it is the general characteristic of equity that the amount of the principal and the dividend is never promised to be paid. It is upon the discretion of directors of the organization. If they do want to pay the dividend, they will be paying. If they do not, they are not going to pay. Okay, this is what we normally see in the application of the ordinary shareholders. So then they say if preference shares are redeemable or have fixed cumulative dividend. Fixed cumulative dividend means that every year a fixed amount of dividend is promised to be paid. And if that amount is not going to be paid, it is going to be accumulated year on year. If in the first year it's not been paid, in the second year, together with the amount of the first year dividend, the second year dividend is also going to be paid. So, or have a fixed cumulative dividend, they are classified as a financial liability. The key element is that where there is an obligation, the instrument represents a liability. So, how are you going to determine that whether the preference share, which is presented in front of you, is an equity or a liability, you are going to see its characteristic. So where there is an obligation, the financial instrument will be considered as a debt instrument. When there is no obligation, it will simply be considered as a share. Now they are explaining about the interest and dividends, which I have already explained. Let's see what your book says. The accounting treatment of interest and dividends depend upon the accounting treatment of the underlying instrument itself. Equity dividends declared are reported directly in equity. Dividends on instruments classified as liability are treated as the finance cost in SOPL. So simply saying that if there is a redeemable preference share, the return which you are going to give on the redeemable preference share will be considered as your finance cost. And you are going to classify it as your interest, finance cost in your SOPL. The return on the irredeemable preference share is your dividend, and this dividend will be classified in statement of changes in equity only. What is the only place for the dividend to go? Statement of changes in equity. So at any other place, it will not be presented. Is everyone cleared up till here? Any confusion? Yes, Ali. Cleared? Not cleared? No. Cleared? Okay. Okay. Now, students, we are going to do this understanding number 2. In this understanding number 2, there is no new principle which is going to be applied. It is purely dependent upon the same principles which we have discussed in our previous lecture. Some of you were not there in the previous lecture, but I just recommend you to go through the recording. You went through, and did you understand? Okay, great. Now, students, the requirement of the question, as we can see, how would these redeemable preference shares appear in the financial statements for the years ending 31st March 2008 and 2009? Since the preference shares are redeemable, it means that it is a financial liability. So this is the first thing which you are going to determine in your exam question. Students, in IFRS 9, financial liability is going to be tested. They are going to test it. The way in which I have told you that how can we calculate the amortized cost, this is going to be tested in your examination, okay? So please be very clear about this. So how would these redeemable preference shares appear in the financial statements for the year ending 31st March 2008 and 2009? If the year ending date is 31st March 2008, it means that the year starting date has been 1st April 2007. Is it? Now let's see the scenario. On 1st April 2007, immediately at the start of the year, on 1st April 2007, a company issued $40,000 one redeemable preference share. Students, this value which is written together with the name of the share or the loan note is a nominal value. And dividend or the liability is always calculated on the nominal value. Please keep this thing in your mind. This is a very basic principle. This is just a repetition of the concepts. The dividend or the interest is always calculated on the nominal value of the shares or the nominal values of the loan notes. And together with that, sometimes with the nominal value, they are going to give you an interest rate as well, which is known as coupon rate. That coupon rate is basically an interest rate which is going to be calculated in interest paid column. Okay, that coupon rate. On 1st April 2007, a company issued $40,001 redeemable preference shares with a coupon rate of 8% at par. At par means that on the nominal value, the shares have been issued. There are two ways in which the shares can be issued, at par or at premium. When the organization is issuing the shares at their nominal value, it means that they are issuing the shares at par. If the shares are being issued at premium, it means that at the amount over and above, the nominal value is being taken at the time of issuing shares. If the par value is 1 and the company is issuing the shares at $1, it is issuance at par. If they are issuing the shares at $1.2 per share, it means that they are taking a premium of 0.2 per share. Clear? So the company has issued 40,000 redeemable preference shares with a coupon rate of 8% at par. They are redeemable at a large premium, which gives them an effective finance cost of 12% per annum. Since the organization is promising to return that amount of the shares at a premium over and above the nominal amount, it means that an effective interest is also going to be applied. Since at the end of whatever year limit is there, at the end of 3 years, whatever the redemption date is there, we have to return the amount including the premium. So that is why we have to account this for in our books as per this principle. So how would these redeemable preference shares appear in the financial statements for the year ending 31st March 2008 and 2009? Can you start doing this question? What we are going to do, we have to classify them as the amortized cost. And whenever we have to calculate anything as per amortized cost, we are going to make few columns. Is it? What few columns we are going to make? Very good. Balance at the start of the year. Very good. Finance cost, which is calculated on the effective rate of interest. Is it? And effective rate of interest is the one which is going to be recognized in our SOPL as well. The calculations which we are going to get in this column are going to be taken to our SOP. So what is an effective rate of interest? It is 12%. The third column is for excellent interest paid. The amount of interest paid is, the rate of interest paid is 8%. That is coupon rate. That is a nominal value. And the last one is balance at the end of the year. So these 4 columns we are going to make, and we are required to calculate the amount which has to be taken in the financial statements for year ended 31st March 2008 and 31st March 2009. So actually we have 2 years under consideration. What is going to be the value at 31st March 2008? What is going to be the value at 31st March 2009? So at the start of the year, on 1st April 2007, what has been the value? 40,000. Is it? 40,000 multiplied by 12%, how much it is? Calculate it, let me know. 4,800 is it? 4,800. And what is the interest paid? 40,000 multiplied by 8? 3,200? 3,200. Now calculate it, 14,000 plus 4,800 minus 3,200. 4,160. This will be the amount at the end of the year. At the start of the year on 1st April 2007, this has been the value. At the end of the year at 31st March 2008, this has been the value. Got it? This will be taken in the SOFP as our long-term liability. And in our SOPL, this amount will be taken. In our SOPL, this amount will be taken for the year ended 31st March 2008. This is the accounting. Then for 31st March 2009, again we are going to repeat the same practice, but now the balance at the end of the year will be coming at the balance at the start of the year. It is 416,000. 416,000 multiplied by 12%. 4,992. And this interest paid is going to remain the same. It will remain same, 3,200. Now calculate it, 416,000 plus 4,992 minus 3,200. 4,339. Now at the year ended 31st March 2009, this amount will be taken as a finance cost in SOPL, and this amount will be taken as a liability in our SOFP under the section of long-term liabilities. This will be the accounting treatment for 31st March 2008 and 31st March 2009. So this is the calculation under amortized cost. What has been the amortized cost? For 2 years we have seen. For the first year end, it has been 416,000. For the second year, it has been 4,339. Is everyone clear? So this has been the repetition of the same principles which we have discussed. in our previous lecture. Have a look at this question and then we are going to move on. Shall we move on? Okay. Now, students, in financial liabilities, the next concept which we are going to study is compound instruments. This is a portion which is going to be tested in the examination. Maybe you will be facing a total of the trial balance and you will have to prepare the statement of profit or loss and SOFP, and one of the adjustments could be regarding financial instruments. So compound instrument is the favorite topic of the examiner. It comes in the examination. Compound instruments. Compound financial instruments are one of the kinds of the financial instruments which are having the characteristics of both the equity and liability. At the same time, they will be having the characteristics of the liability as well as the equity. This happens in the case of the convertibles or the options. Sometimes the entities, when they do issue the loan notes, they give the option to the other persons that at the time of the redemption, you will be given an option to convert your loan notes into the shares of the company. Or sometimes the companies do issue the shares to the general public at the time of the issuance. They do give an option to the other persons that at the time of redemption, you can convert your shares into the loan notes. So in the case of the convertibles or in the case of the options, you will be having a look at the characteristics of the compound instruments. How does the options and convertibles actually work in the finance language is not the subject area of F7. This is what you are going to discuss in F9. But obviously, the books of accounts, how it has to be recognized, it is the subject matter of F7. So what are compound instruments? These are the financial instruments which are having the characteristics of liabilities and equities both at the same moment. What your book says about it, let's see. A compound instrument is the financial instrument that has the characteristics of both equity and liability, such as a convertible loan. A convertible loan has the following characteristics. It is repayable at the lender's option in shares of the issuing company instead of cash. So at the time of issuing a loan, the company promises the lender that at the time of redemption, instead of taking cash, you can take the equity of the company. Getting my point? Say, for example, Rabia has purchased the shares of my company, and I promise at the time of issuance that when the time of the redemption is going to come, you can take the loan notes instead of taking the cash back. And this can happen in the other way as well. In the case of the loan notes or in the case of the equity, it can happen. What is the second characteristic? The number of shares to be issued is fixed at the inception of the loan. How many shares are going to be given to the lender is going to be fixed at the time of the inception. At the time of taking a loan, company is going to fix the amount of the shares which is going to be offered at the time of the redemption. The lender will accept the rate of interest below the market rate of non-convertible instruments. The rate of interest which is being offered on the convertibles is usually lesser comparatively to the market rate of interest prevailing because lesser risk, lesser return. This is the key principle of finance because the debts are going to be converted into the equity. That is why the lender is taking lesser risk. So when there is a lesser risk, they have to accept the lesser rate of interest as well. They have to accept the lesser return also. So three key principles are going to be applied in the case of the convertible loan. The first one is that it is repayable at the lender's option. Whatever the option of the lender is present, according to that, it is going to be redeemed. If they do want to accept the cash at the time of redemption, they can. But if they do want to convert the loan notes into the shares, they can do that as well. What is the second characteristic? The number of the shares to be issued at the time of the redemption is fixed at the date of inception. What is the third characteristic? The lender will accept a rate of interest below the market rate for non-convertible instruments. The rate of interest which is being applied, which is being promised to be paid on the convertibles is usually lesser than the market rate of interest. They say, as the lender is allowing the company a discounted rate in return for the potential issue of equity, these convertible instruments are accounted for using split accounting, recognizing both their equity and liability components. Since these the compound instruments are having the characteristics of both equity and liability in them, that is why at the time of inception and at the time of the subsequent accounting, we have to split the accounting treatment as well. Some of the element of the total amount which is being given by the lender has to be accounted for as the financial liability, and some of it has to be accounted for as equity. Say, for example, when you do take a loan, what is an accounting entry? Debit bank account, credit loan account, or debit bank account, credit financial liability account. Since the instrument is having the characteristic of both the liability and equity, that is why your accounting entry will become debit bank account, credit financial liability, and credit equity also. So what amount you are now supposed to write in front of liability and in front of equity, this is the point of concern. So this is known as split accounting. We have to calculate the values of both the amounts which we have to write in front of liability and in front of equity. So they say there is a liability or debt element as the issuer has the potential obligation to deliver cash. There is also an equity element as the investors may choose to convert the loan into shares instead. The accounting for a convertible loan falls into two stages, initial and subsequent measurement. As we have seen for all the cases, the accounting treatment does lie into two phases. Initial recognition at the time of inception, at the time of occurrence, what amount we have to write in our books of accounts. And once after the first year has passed, subsequently at which amount we have to measure it. The same we have to apply in the case of this compound instrument as well, at which amount we are going to recognize our equity and financial liability at the time of taking a loan, and what is going to be the subsequent measure. Initial recognition, always an initial recognition has to be done on the fair value. And what is a fair value for the loan? Obviously, the amount which has been taken as a loan is the fair value. So what they say, the liability is measured at its fair value. The fair value is the present value of the future cash flows. Now, in the case of compound instruments, you have to consider the point of view of the present value as well. Since at the time of the inception, you have to write the values in your books of accounts, but those values are actually going to occur year after year. So how much actual liability you have to write, you have to calculate right now at the moment. So the future values obviously have to be converted into the present values. So the present values of the cash flows, interest and capital discounted using the market rate of interest for non-convertible debt instruments. And in order to convert the future value into the present value, which discount rate you are going to use? That is the market value of the interest, market rate of interest for non-convertible instruments. So they will be giving you this information clearly in the exam question, but you have to keep in mind that which rate of interest has to be used for discounting. It is the market rate of interest for non-convertible instruments. And the equity element is equal to the loan proceeds less the calculated liability element. Now we are practically going to see that how are we going to calculate it, but theoretically they are telling you that what amount you have to write in front of equity. The present value of the cash flows will be lesser than the amount of the total loan which you are going to receive, which the company is going to receive. So the difference between the actual amount of the loan being received and the present value will be the portion of equity. And this equity is going to remain the same year on year. The value of the equity is not going to change in the subsequent years, but the value of the liability will be changing subsequently year after year. So let's see the subsequent measurement. Students, I can understand, obviously theoretically you cannot understand. So we are going to do the understanding for this. Subsequent measurement. The liability is measured at amortized cost. Now subsequently, the liability will again be recognized at the amortized cost, having the same principles: initial value balance at the start of the year plus market rate of interest. You can consider it as the effective rate of interest minus interest paid. And for equity, what they say, the equity is not remeasured and remains at the same value on the statement of financial position until the debt is redeemed. And we are not going to change the position of the equity in the future years. It is going to remain the same anyhow. As regard you understanding the concepts?
Kind of, miss.
Okay, you started, actually, I didn't see you in the start of the lecture, so you started the lecture a little bit late.
Yeah,
so
it's
if
okay,
you do not
miss.
understand anything, you can ask me.
Okay, miss.
Okay. Now, students, in regards to the compound instruments, we are going to do this illustration. The requirement of the question is split the loan between debt and equity at inception and calculate the finance charge for each year until conversion or redemption. So what are the two requirements? You have to split the loan between debt and equity at inception. You have to calculate the values of debt and equity at the inception at the time of taking a loan, and calculate the finance charge for each year until conversion or redemption. So these two requirements are there. Let's see what we are going to do. Convert company issues a convertible loan that pays interest of 2% per annum in arrears. In arrears means that after the year end, we are paying it. Okay. The market rate is 8%, being the interest rate for an equivalent debt without the conversion option. So this 8% is going to be the discount rate which we have to use in order to calculate the present value of the cash flows. That is the market value, market rate of interest for the debts without the conversion option, without the which are non-convertible debts. The loan of 5 million is repayable in full after 3 years or convertible to equity. Discount factors are as follows. Years are being given and discount factor at 8% are being given. The same type of the question you can see in the examination as well. So what we are going to do, let's have a look. At the time of the inception, at which amount we have to recognize this debt? When the debt is actually being taken, we have to calculate the present value of the cash flows, is it? And this is the amount at which we have to recognize the debt initially at the time of the inception. Students, when the loan is being taken, under the case of the compound instrument, what accounting entry we are going to pass? That will be debit, bank account, credit, financial, liability account, and credit. Yes, dear. Credit equity account. This is an accounting entry which we have to pass in the case of the compound instrument. How are you listening? Fine. Okay. Now, what amounts we have to record in the front of this accounting entry? This is what we have to establish. Now, what we have to do at the time of the inception, we have to calculate the present value of the cash. How many years are under consideration? 1, 2, and 3. So year 1, 2, and 3 are under consideration. We have to see the cash flows which are going to occur in these 3 years. In the first year, we are going to pay the interest. In the second year, we are going to pay the interest. In the third year, we are going to return the principal amount together with the interest. As it is happening in arrears, we have to assume that at the end of the year, the transactions are complete. How much loan has been there? The loan is for $5 million. So in the first year, how much interest has to be paid? How much interest is there, students? 2%. The coupon rate is 2%. So 5 million multiplied by 2%. Either you can do 1,500,000 multiplied by 2% or simply do 5,000 multiplied by 2%. So in thousands we can write. So 5,000 multiplied by 2%. 100. So in the first year, the cash flow will be 100. This is an amount of interest which has to be paid. How have we calculated it, students? 5,000 multiplied by 2%. At coupon rate, we are going to calculate the interest. In the second year, again, this amount of 100 is going to be paid as an interest. In the third year, it has to be returned together with the principal amount. The loan has to be returned and the interest has also to be paid. So 5,000 or 5 million amount of principal and 100 is the amount of interest. So the third year, how much we have to pay? 51. These are going to be the cash flows in the 3 years. Now we have to calculate the present value of these cash flows. So for that, we have to calculate, we have to see the discounting factors as well. So which discounting factors we are going to use? That is the market rate of interest for the equivalent non-convertible debt, which they have given to us as how much? 8%. They are telling us in the second line, the market rate is 8% being the interest rate for an equivalent debt without the conversion option. 8% discounting factor which we are going to use. At that discounting factor, the discounting factors are 0.926, 0.857 and 0.794. Now we can calculate the present values. What is the formula of present value, students? Future value multiplied by discounting factor. The discounting factor is 1 over 1 plus r raised to the power n. Anyhow, 100 into 0.926, 92.6. Is it? You can take it as 90. Then 100 into 0.857, it's 85.7. You can take it as 86. Then 5100 multiplied by 0.794. Calculate. 49.4. So we can take 4049. How much total value is there? 4049 plus 86 plus 93. Total of the present values. 4198 is the total value. Is it? No, dear. 4228. 4228. 4228 is the total value. Students, this is the split of debt. How much total loan has been there? Total has been 5,000. We are working in thousands. Total has been 5,000. How much loan has been taken? 5,000. This is the present value of the debt. This is the amount at which at the time of inception we are going to recognize our liability. And the remaining amount is going to be classified under equity. So 5,000 minus 4,228. Sorry? 772 will be taken under equity. So how are we going to write the amounts in front of this accounting entry? 5,000 here in front of financial liability at the time of inception, 4,228 and 772 in front of equity. This is the initial recognition of the compound instrument. Is everyone clear? Have a look at this portion that we have done. This is the first PST. Sure, please. Students, this is the initial recognition of the compound instrument. At the time of inception, this is an accounting entry which we are going to pass. This is an amount which we are going to take into our books of accounts. But it doesn't mean that this is going to be the amount which we have to write in our financial liability in our SOFP as well. Because this is the balance at the start of the year. Balance at the start of the year, we do take to the ledger account and we do have to make the adjustments in our whole year in that ledger account. And then the balance at the end of the year is being taken to the SOF. At the time of the occurrence of the liability, this is the accounting entry which we are going to pass. We are going to take it to the ledger accounts, but this amount will not be written in our SOF. Because in financial liability only, the balance at the end of the year has to be taken to our SOF. So how much time period for loan has been there? 3 years. At the end of the 3 years, it has to be redeemed. So now we are going to do the same amortized cost calculation in order to calculate the value of the loan in the subsequent years. So we are done with the first requirement, and now we have to calculate the second requirement. We have to calculate the finance charge for each year. We are going to make the same columns, year 1, 2, 3, balance at start. Then, but we have to write finance cost, then interest paid, and then balance at the end of the year. Finance cost has to be calculated at which rate of interest? 8%. It's 8%, interest paid at 2%. So what has been the balance at the start of the year for finance cost? 4,228. 4,228. This is the financial liability amount which we have calculated here. There. So 4,228 is going to be written over here. Now calculate the finance cost on 4,228. 338.24. 4,228 multiplied by 8%. How much? 338.24. So we are going to take 338. How much interest paid we are going to take, students? Tell me. How much interest paid we are going to take? Are we going to calculate it on 4,228? Interest paid is 2%. At which amount are we going to calculate it? No. On the nominal value, it has to be calculated. What is the nominal value? 5,000. The interest paid will be 100. It will remain 100. This is the point in which the students can do the mistake. So now what is the balance at the end of the year? 4,228 plus 338 minus 100. 4466. Now 4466 is going to come here. Now calculate for the rest of the years as 357. All of you calculate. Quickly calculate. Interest paid is going to remain the same, 100, 100. Is it you do not write in the classroom, then how do you understand the concepts? Are you taking tuitions? Then how are you understanding the concepts? Okay, try to store the concepts then in your mind, but I think that it's very difficult. Let's take a look at picture. Yes. 5,000. Yes, it has to be 5,000. The amount of the interest, or the amount of the principal. So 4466 multiplied by 0.08, it's 357. This interest paid is going to remain the same, and then 4466 plus 357, 4723. 4723 is going to be taken over here. Then 8%, 377. It will remain the same, and it will become 5,000 at the end of the year. Okay, so this is going to be the long-term liability in our first year. So are we going to take it in our SOPL? Obviously, in SOPL, they have required us the finance charge to be calculated. So in year 1, in year 2, and year 3, what is going to be the finance charge? For year 1, it will be 338. For year 2, it will be 357. For the year 3, it will be 377. This is the finance cost to be taken to SOPL, and in our SOFP, as our long-term liability, how much we have to take? For the first year, it's 4466. For the second year, it's 4723. And for the third year, it's 5000, which has to be paid at the end of the year 3. Students, this is going to be tested in the examination. So which amounts you have to take, at which place you should be considering it, and which amounts you have to calculate, you are also supposed to do that. Quickly have a look at this question. If you are clear, then we can move on. So please keep in mind that the amount which you are going to calculate at the initial recognition stage is not the one which you have to take in SOF. At the initial inception, 4228 has been calculated, but in that amount, we have to add up the finance cost, we have to deduct the interest rate, and final amount 4466 has to be taken in our SOFP at the end of the year. Got it? Yes, dear. Long-term liability. Okay, now students, understanding number 3 is there. It's a detailed understanding, yes. So the requirement of the question is what amounts will be shown as a financial liability and as equity when the convertible bonds are issued. Students, again, you have to use the split accounting principles, and at the time of inception, what amount you have to write in financial liability and equity. This is the first requirement of the question. Then what amounts will be shown in SOPL and SOFP for years 1 to 3. So same type of calculations you have to do in this question as well. Work to the nearest thousands. So we have convertible bonds again. Try to do this question by yourself. It's on the same principles. So I'm not erasing this solution so that you can have a support. Yes, students, finished? Not yet? Yes, also finished? Finished? Oh. Now, students, we can start doing this question. I will be solving it over here, and you can just recheck whether your calculations are correct or no. So I'm not going to remove this all. At the time of inception, what accounting entry has to be passed? Debit bank account, credit, financial liability, credit, equity, in the case of the compound instruments. They say, students, an entity issues 2% convertible bonds at their nominal value of 36,000. So at the nominal value, interest paid has to be calculated on this. Interest is payable annually in arrears. The bonds are convertible at any time up to maturity into 40 ordinary shares for each $100 of bond. Alternatively, the bonds will be redeemed at par after 3 years. Similar non-convertible bonds would carry an interest rate of 9.1%. That is going to be our effective rate of interest. The present value of $1 payable at the end of the year based on rates of 2% and 9.1% are as follows. So which rate of interest we are going to use? 9.1%. That is for the equivalent non-convertible bonds. So first we have to calculate the present value to recognize the value at the time of the inception. How much cash flows are going to occur at the year 1? At year 1, how much cash flows are going to be there? And 36,000, how much interest we have to pay? 2%. 36,000 multiplied by 2%, how much it is? 720 would be the cash flow at first year. We have calculated it at 2%. That is the nominal rate of interest. At year 2 again, this amount is going to occur. Interest has to be paid. At the third year, this has to be returned at par. As you can see over here in this line, redeemed at par after 3 years. So this means that 36,000 together with the 720 has to be paid. So how much it is going to be? 36,720 has to be paid at the end of the year. Now we have to convert them into the present value using the discounting factor for the equivalent non-convertible bonds. So you can see the rate of interest, 9.1% is carrying the discounting factors as 0.92, 0.84, and 0.77. So what are the present values? Calculate 720 multiplied by 0.92. 662. 0.4. 720 into 0.84. 604. 36720 multiplied by 0.77. 28274. Total them all. 295. 40. Are you sure? Second one is 604. 605 by rounding. It's okay. You can take 604. So this is an amount which has to be going to the debt amount, and the total amount of the debt has been how much? 36,000. So remaining portion belongs to equity. 36,000 minus 29540. 6460 will be going to the equity. So how much amount we are going to write over here now? 36,000 is total. 6460 is for equity and 29540 is for financial liability. Clear up to here? So this is the amount which we have to write at the time of the initial inception. And this equity amount is going to remain the same in all the 3 years. It is not going to change. Now we have to calculate the amortized cost of the financial liability for subsequent measurement. So we are going to do the same, which we have done in the previous question. Finance cost interest rate will be 9.1%, whereas interest paid will be 2%. 2%. So balance at the start of the year has been how much, students? 29540, is it? Yes, 29540 is at the start. Now 9.1% on 29540, how much it is? Be very careful in calculations because 2688, 2668. Interest paid would be how much? Now tell me. How much interest paid would be there? Sorry? 6460. How much interest paid would be there? 720. The interest paid is going to remain the same. 720, 720, and 720. Now 29540 plus 2668 minus 720. 31488. So it will become the balance at the start 31488. How much finance cost? 31488 into 9.1%. 2865. Okay, 2865 plus 31488. Minus 720. How much? 33633. 33633 multiplied by 9.1%. 3060 plus 33633. It has to be 36,000 in our account. 35973. It means that you have done a mistake somewhere. It has to be, how much are you getting? 73. It means that in rounding or somewhere you have done a mistake. That is why a big distance is occurring. Otherwise, it has to be 36,000. Or $1 would be lesser, or $2 would be lesser, but not this much. Okay. So please recheck it. Anyhow, how much it is? 35973. Is it?
Yes, ma'am.
So it has to be 36,000.
The finance was the first year is 2688.
268. So that's the mistake. Because of that, we are getting the answer which is a little bit far from 36,000. So be careful about the calculations. Yes, Hamza, any confusion?
No. I can't see.
You can't see it? Okay. So it's the balance at the start of the year is okay. The balance at the start is 29540.
Okay.
But you are not able to see, you can just tell me. All of it are fine. So yes, students, how much amount we have to take in our financial statements, year 1, year 2, year 3. The finance cost would be 2688 as Asim was telling, but as per our calculation, we are going to write it now. 2668, 2865, and 3060. In our SOFP, under the section of long-term liability, how much amount we are going to write? 31488. 33633 and 35973. And under the head of equity in SOFP, how much we are going to write? It will remain the same amount, that is 6460, which we are going to calculate at the time of inception. Yes, so $3 is okay. 35997, it's fine. Now, students, the second part of this understanding, the requirement of the question, as you can see, what amounts will be shown as the financial liability and as equity when the convertible bonds are issued. So the same requirement at the time of inception, what amounts you are required to write. And what amounts will be shown in the SOPL and SOFP for years 1 to 3. So a company issues 4% convertible bonds. Again, convertible bonds are there. So please do this question once again by yourself for the revision of the concept. Same type of question is there, no difference is present. Students, in the exam questions also, they will be giving you the discount factors at 2 different rates. Just to examine that, do you know the concept behind? So you have to take the discounting factors at the market rate of the equivalent non-convertible debt. Finished? This one is finished. The next one is good. So to check whether your answer is correct or not, you will see that at the end of redemption, your amount should be the same as the amount of the loan. So it has to be 5 million. Yes, my online students, Marwa, Afaq, Angelica. If you feel any confusion, you can ask. Yes, students, once you finish, let me know. Shall I do this question or it's fine for you? Fine? Are you getting 5 million at the end of the third year? No, great. So we are not going to do this question in the classroom. If you want me to do this, I can. Fine? Okay. Yes, Hamza. Shall we move on? Are you cleared? Okay. Now, students, we are ending with the discussion of financial liabilities. The topic of financial liabilities under financial instruments is over. This is all what we had to discuss in financial liabilities. Now we are going to start with the discussion of financial assets. Regarding financial assets, they are not giving a lot of detail, and the questions are also not present in regards to the financial assets. So this is not what we can say generally examinable topic. Or on the other hand, you can consider that financial assets are also going to be calculated in the same way as we have calculated financial liability. Say, for example, in the previous questions, you were assuming that loan has been taken. In this case of the financial asset, you are going to become the other party who is giving a loan. And you are going to recognize the asset in your books of accounts in the amortized cost way. So the same principles are going to apply in the case of financial asset. No difference is there, but you are going to assume that you are a party which is having an asset in the case of this slide. So let's see what your book says about it. Initial recognition of the financial assets. IFRS 9 deals with the recognition and measurement of financial assets. An entity shall recognize the financial assets on its SOFP when and only when the entity becomes party to the contractual provisions of the instrument. If by contract, the organization is giving the loan to the other party, say for example, we are an entity who is giving a loan to the other entity, the contractual obligation is present and we are now supposed to write it as a financial asset in our books of accounts. How are we going to initially measure the financial assets? Let's see. At initial recognition, all financial assets are measured at fair value. This is likely to be the purchase consideration paid to acquire the financial assets. Transaction costs are included unless the asset is a fair value through profit or loss. What is a fair value through profit or loss? We are going to discuss this concept in detail. Now, this is all the discussion in regards to the financial assets. No more discussion is present in your book or in your revision kit in regards to the financial assets. Now we are going to start the discussion in regards to the equity instruments. Students, over here, the equity instruments have to be considered not in the case that you are issuing the equity. You are not going to be the issuer of the equity when you are going to consider financial instruments, equity instruments. You will consider equity as an investment in the other company. So consider that equity is also going to be your asset in this case. Equity is a separate thing in SOFP. But since over here we are discussing from the different perspective, this equity will be your asset. It will be considered as an investment in the other company. When you are purchasing an equity, that equity is not going to be regarded as equity in your SOFP. It will be regarded as an investment. It's an asset basically for you. Getting it? So in this regard, they are going to discuss this financial instrument over here. Equity instruments, purchases of shares in other entities. So in the first line, they have elaborated that over here, equity instruments means purchasing of shares in the other entity. In SOFP, when you are writing an equity over there, it means that you are issuing the equity. You are taking an amount and you are issuing the shares. But over here, as a financial instrument, you are going to assume that you are investing in the other company, you are purchasing the shares of the other company. So you are not supposed to write this amount in your equity, but as your asset in your SOFP, and the income which you are going to generate on these equity shares will be regarded as interest income, or it will be regarded as what? Dividend. Equity instruments, purchase of shares in other entities are measured at either fair value through profit or loss or fair value through other comprehensive income. Now, students, when you are purchasing the equity in the other company, the standard IFRS 5 gives us the liberty to choose any of the two methods. We can adopt fair value through profit or loss, or we can adopt fair value through other comprehensive income. Students, default method of calculating the equity instrument is fair value through profit or loss. If no information is being provided and you are not holding the financial instrument for trading purposes, then you can adopt fair value through profit or loss. If for trading purposes you are having this equity instrument, then you have to adopt fair value through other comprehensive income. And how are we going to treat under both the methods? The method is same. The method is going to remain the same with little bit difference. What is that we are going to consider? When we are adopting fair value through profit or loss, they say this is the default category for equity investments. If nothing is being mentioned, by default, you are going to account for this as per fair value through profit or loss. Students, which simply means that whenever the difference in the fair value, difference in the market value of the shares and the book value of the shares is going to be happening, you have to recognize it in your SOPL. This is fair value through profit or loss. Obviously, the amount at which you have purchased the shares is going to be different with the market value. Market value keeps on fluctuating. So when the value is going to fluctuate and you find that market value of the shares which have been purchased is higher than the book value, you are going to take the gain to your SOPL straight away. But one thing you have to keep in mind that if your fair value is lesser than the market, lesser than the book value, it's a loss. This loss will not be recognized in SOPL. It will not be taken to revaluation reserve. The negative value will not be taken to the revaluation reserve if fair value through profit or loss is being adopted. So these are the key points which you have to learn, students. With the passage of time, with revising again and again, these concepts will become your normal thing in your mind. Anyhow, they say any transaction cost associated with the purchase of these investments are expensed to the profit or loss. When you are adopting the category of fair value through other comprehensive income, the transaction costs are going to be capitalized. Whereas when you are adopting fair value through profit or loss, any transaction cost, say for example, any costs which are being incurred in order to purchase the shares are going to be expensed in statement of profit or loss. Clear? What are the transaction costs? If say for example, you want to purchase the shares of any company, the broker charges are going to be there. The legal charges are going to be there. The paper cost is also going to be there. These transaction costs are going to be expensed off if you are adopting the category of fair value through profit or loss. They will not be becoming the part of the asset, okay? And not included within the initial value of the asset. The investments are then revalued to fair value at each year end with any gain or loss being shown in the statement of profit or loss. So what is the fair value through profit or loss? It is the default category for the equity instruments, and the transaction costs are not going to be capitalized when you are adopting fair value through profit or loss. Any kind of gain or loss which is happening in the case of the revaluation has to be taken to the SOPL as an investment income. If you are adopting fair value through other comprehensive income, what is the condition? Instead of classifying equity investments as fair value through profit or loss, an entity may designate the investment as fair value through other comprehensive income. The designation must be made on acquisition and can only be done if the investment is intended as long-term investment. Once designated, this category cannot later be changed to fair value through profit or loss. Students, once this category of fair value through other comprehensive income is adopted, then you cannot change it later to fair value through profit or loss. Okay, the default category is fair value through profit or loss. Once recognized as fair value through profit or loss, it can be changed to fair value through other comprehensive income. But if fair value through other comprehensive income is being adopted, then you cannot change it to the default category. Then under fair value through other comprehensive income, transaction costs are capitalized. Transaction costs are also going to become the part of the asset at the time of initial inception. In the case of fair value through profit or loss, they are going to be expensed off simply. The investments are revalued at fair value at each year end, with any gain or loss being shown in the other comprehensive income and taken to the investment reserve in equity. Students, in statement of profit or loss, when we are adopting fair value through profit or loss, the gain is not taken to the reserve. It will not be taken under the reserve. But if we are adopting the fair value through other comprehensive income, then it will be taken, if there is a gain, it has to be taken to the investment reserve in equity also. And it can become negative also. If there is a downward revaluation, you can take the negative reserve to the investment reserve in equity also. Clear? Okay, this is similar to the revaluation of property, plant and equipment under IS 16. The main difference is that the investment reserve can be negative. In IS 16, revaluation reserve can never be negative. But in IFRS 9, revaluation, the reserve, the investment reserve can be negative as well. If a fair value through other comprehensive income investment is sold, the investment reserve can be transferred to retained earnings or left in. In the case of IS 16, if you can recall, when the asset is being sold, the revalued asset is being sold, the revaluation reserve of that asset has to be transferred to the retained earnings, having an accounting entry of debit revaluation reserve, credit retained earnings. Can you recall? But in this case, it's up to you. If you do want to transfer the reserve to the retained earnings, you can. If you do not want to do that, even then it's fine. It can become the part of the equity even then. Now, students, financial instrument regarding debt instruments. Debt instruments can also be examined in the examination as a part of the financial liabilities. Got it? Or the financial assets as well. Students, we can have a break and after that we can discuss if it's fine. I think that you are not able to absorb more. Shall we continue or shall we have a break first? After the break? Okay, we are going to discuss it after the break. Okay, my online students, we are going to resume after the break. Yes, students, online students. We are going to resume class now, students. As you do know that before to the break, we were having a discussion regarding debt instruments for financial instruments. Now, we have discussed earlier about the financial liabilities. Debt instrument is also the category of the financial liabilities. It's not different. But we have discussed only about the amortized cost in the financial instruments liabilities. But it can be recognized in the other ways as well. When we are holding a financial liability, not for a trading purposes, we have taken a loan, or we have taken a loan, it's a liability. But the loan notes are not going to be sold until redemption. So we have not purchased them, we have not taken them for the purpose of trading. If we have not taken the loan notes for the purpose of trading, in that case, we are going to recognize them at their amortized cost. So one of the category when we are going to recognize the financial liabilities at amortized cost is being discussed. But we can recognize the debt instruments with the other ways as well. That is fair value through profit or loss and fair value through other comprehensive income if certain conditions are going to be met. What happens in actual? There are two tests which we have to consider. If they are being fulfilled, then we are going to consider the fair value through profit or loss. If they are not, we are going to consider it as fair value through other comprehensive. What are those? We are going to look at this particular slide. They say debt instruments such as bonds or redeemable preference shares are categorized in one of three ways: fair value through profit or loss, amortized cost, fair value through other comprehensive income. Now, fair value through profit or loss is a default category, as we have seen in the case of the financial assets as well. We have seen in the case of the equity instruments also. This is a default category. But in regards to the amortized cost and fair value through other comprehensive income, we have to pass our transactions through two tests. Those two tests are contractual obligations test and business model test. What is a business model test? Business model tells us that what is the purpose of taking a financial instrument. That is a business model test. Are we taking a financial instrument for the purpose of trading, or we are not taking it for the purpose of trading? This is a business model test. The second test is contractual obligation test. What we are perceived to return in the case of the contractual obligation, whether it's in interest or principal only, or any other obligations are also arising. So what your book says, the default category is again fair value through profit or loss. The other two categories depend upon the instrument passing two tests. So by default, if nothing is given, no information is present, you are going to do fair value through profit or loss, which simply means that whatever gains are there, you are going to take them to your statement of profit or loss, and the transaction costs. The transactions costs are not going to become the part of the asset or the liability. They will be expensed in SOP. This is the difference of the default category and the other two categories, amortized cost and fair value through other comprehensive. Anyhow, the default category is again fair value through profit or loss. The other two categories depend upon the instrument passing two tests. Business model test. This considers the entity's purpose in holding the investment. Contractual cash flow characteristics test. This looks at the cash that will be received as a result of holding the investment and considers what it comprises. So mainly it is interest and principal amount. Now let's see about the amortized cost. This is a particular phase which has already been discussed. Maybe if you remember when we started discussing about the financial liabilities in the previous lectures, I told you in the start that over here we are discussing about those liabilities whose purpose is not trading. Look, some liabilities are being held for the purpose of trading. Say for example, we are taking a loan note, and with the passage of time, the amount of the loan note, the fair value of the loan note is increasing. So we are not going to wait for redemption. We are going to sell it in the market. This is held for trading purposes. If we are not holding a loan note for trading purposes, it means that we are going to wait until redemption, and at redemption, we are going to take back our principal amount, and in due time, we are going to take the interest payments as well. So these can be the two purposes. So if we are not holding a loan for the purpose of trading, then we are going to measure it at its amortized cost. And that is the business model test telling us that the purpose of having a loan note is not trading. This is what we have discussed earlier as well. But here they are revising it again, so do not be confused. They say for an instrument to be carried at amortized cost, the two tests to be passed are: number one, business model test. The entity must intend to hold the investment to maturity, which means that up till redemption date, the loan notes are going to be kept by the entity, and at redemption, the cash proceeds are going to be taken. Got it? So it's not for trading purposes. So simply telling you that if the purpose of the loan note is not for trading purposes, then you have to recognize it, you have to measure it at its amortized cost. And the second test is contractual cash flow characteristics test. The contractual terms of the financial asset must give rise to cash flows that are solely of principal and interest. If we are having this thing in our mind that we have to keep the loan notes until redemption, It means that the cash flow which is going to arise out of those loan notes is only because of the amount of the principal and the amount of the interest. So only these two cash flows are going to occur in that case. If we are holding it for trading purposes, then capital repayment is also going to be taken. The market value of the asset is going to be earned.
Sorry, miss.
It's okay to do.
Ma'am, there was break. Don't blame me.
You wanted to have lunch?
No.
Have you done it already?
No.
Later?
Yeah, but the
Okay, it will become cold. If you want to have it in the class, you can. It's okay. Okay. The contractual terms of the financial assets must give rise to cash flows that are solely of principal interest. Students, you have missed some important part of the discussion.
sorry for that.
Anyhow, we are discussing about the debt instruments in regards to the amortized cost. We have discussed up till now that for recognizing and measuring the debt instruments, we have three methods: fair value through profit or loss, amortized cost, and fair value through other comprehensive income. We have already discussed about financial liabilities. Debt instruments are also one of the kinds of the financial liabilities. And we have discussed about amortized cost earlier as well. So over there in our previous lecture, we were actually discussing about those debt instruments which are not held for trading purposes. When we are not holding a financial liability for the trading purposes, it means that we have to recognize it, we have to measure it at its amortized cost. So basically it means that two tests which we have to apply, business model test and contractual cash flow characteristic test, it tells us that the purpose of holding the investment is not trading. We are going to wait until redemption, and at the redemption date, we are going to get back our cash. So contractual cash flow characteristic test tells us that the major amount of the cash flow is earned through the interest payments and through the principal amount. If a debt instrument is held at amortized cost, the interest income calculated using the effective interest as for liabilities, which we have discussed in detail, will be taken to the SOPL, and at the year-end assets value is similarly calculated using an amortized cost table. So in the case of the debt instruments for assets, by using the same principles, we are going to do that using the table. If there is fair value through other comprehensive income, what is the difference? Students, even if it is amortized cost or if it is fair value through other comprehensive income, in both the cases, transaction costs will be capitalized. Only in the fair value through profit or loss, we do not capitalize the transaction costs, we do expense them off in SOPL. Even if we are adopting amortized cost or fair value through other comprehensive income, in both the cases, transaction costs will become the part of the capitalized assets. When are we going to have the asset being recognized at fair value through other comprehensive income? When the purpose of having an asset is for trading purposes. We can keep the asset up till the redemption date, or during the passage of time. Meantime, if we find a good value of the asset to be sold in the market, we are going to sell it and we are going to get the capital payments. Got it? So when the purpose of having an asset, we are not talking about the asset like plant and machinery because other standards are there for that. Over here, investment asset is being dealt with. So if the purpose of holding an asset is not just to wait until redemption, we can sell it during the life of the asset as well, and we can earn the capital repayments. Then we can categorize it through fair value of other comprehensive income. So for an instrument to be carried at fair value through other comprehensive income, the two tests to be passed are business model test. The entity must intend to hold the investment to maturity, but may sell the asset if the possibility of buying another asset with a higher return arises. So if meanwhile, while waiting for the redemption date, we find that we can get a rise in income by selling the asset, we can sell it as well. Otherwise, we can hold it up till the redemption date also. If it's been categorized through fair value through other comprehensive income, then we cannot recategorize it through fair value through other profit or loss. Got it? We cannot change the category. Contractual cash flow characteristic test is going to be the same in this case as well as we have discussed for amortized cost. So what we are going to get, we are going to get interest and the principal amount, but not on the sole basis. We can get the cash flows in the form of the capital repayment as well. If we are selling our asset during the, during the meantime of the redemption date, we can get the capital repayment as well. So they say the contractual terms of the financial asset must give rise to cash flow that are solely of principal and interest as for amortized cost. Debt instrument is held at fair value through other comprehensive income. The asset is initially recognized at fair value plus transaction cost. So initial recognition will be at the fair value plus transaction cost, and this will remain the same as for fair value at amortized cost also. But it will not be applicable in only fair value through profit or loss. Interest income is calculated using the effective rate of interest in the same way as amounts that would have been recognized in the profit or loss using amortized cost. At the reporting date, the asset will be revalued to fair value with the gain or loss recognized in other comprehensive income. This will be reclassified to profit or loss on disposal of the asset. So now what they are telling over here, they are telling us that what are we going to do as a normal measurement? It is going to be happening in the same way as for the amortized cost, but in the case of fair value through other comprehensive income, we have to see the changes in the market value of the assets as well. So if we do see the case that the market value, the fair value of the asset is more than the book value, in that case, the gain has to be taken to the other comprehensive income. The gain is not going to be taken to the profit or loss. The gain will be taken to the statement of other comprehensive income. And on the contrary, on the other side, the gain has to be taken to the revaluation surplus as well, as we do in the case of IAS 16 also. And they are also telling us that the negative revaluation can also occur. In IAS 16, if there is a negative revaluation, it is taken as an impairment charge. But in financial liabilities, in debt instrument, fair value through other comprehensive income, if there is a loss, it is going to be taken as a negative reserve in our revaluation investment reserve in our equity. So this is the changeover. And on the other hand, that negative charge will be taken to the statement of other comprehensive income as. So on one side, it will be taken to the statement of other comprehensive income. That negative charge, it will be taken as an investment loss as well, and it has to be recognized as a negative under our investment reserve under the head of equity. So how is it going to be practically applied? We are going to see this now. Understanding number 4 is there. It is having 3 parts. So number 1, we are going to see first the requirement of the question. As you can see, what amounts will be shown in the statement of profit or loss and statement of financial position for the financial asset for the year 1, 2, 3. A company invests 5,000 in 10% loan notes. 10% is the nominal rate of interest, coupon rate. The loan notes are repayable at a premium after 3 years. The effective rate of interest is 12%. The company intends to collect the contractual cash flows, which consist solely of repayments of interest and capital, and therefore have chosen to record the financial asset at amortized cost. So they are not leaving it on you to decide that which category you have to select. They have told you by themselves that you have to, you have to recognize them at amortized cost. So you do know the method very simply. You can apply it. The same method we are going to apply over here as well. We have to make few columns. How many years are there? 1, 2, 3, and then balance at start. Then finance cost. Finance cost, how much it is? 12% in the third line it's written. Effective rate of interest is 12%. Then we have interest paid. Nominal rate of interest, how much it is? It is 10%. In the first line it is written. And we are going to calculate the balance at the end of the year. The loan notes are, the company invests 5,000 in 10% loan notes. It's a financial asset. Previously we were discussing in regards to the liability. But at that time also I told you in regards to the financial asset also it is going to remain the same if they are traveling through amortized cost method. So the initial value of the loan is $5,000. So balance at the start of the year is 5,000, is it? So 5,000 multiplied by 12%, how much it is? 600. And 5,000 multiplied by 10%? 5, is it? Now calculate 5,000 plus 600 minus 500. 5,100? 5,100, is it? It will be 5,100. In the next year, it will become 5,100. Then finance cost 612. Interest paid. Calculate it now again. 5,100 plus 612 minus 500. 5,400. 5212. 5212 will be written here now. 5212 multiplied by 12%. So 625, 5212 plus 625 minus 500. 5337. So now students, how much we are going to take in SOPL? In SOPL as our investment income, it's an asset for us. Investment income for year 1 will be how much? 600. For year 2, 612. For year 3, 625. And on the other hand, in our SOFP, in our non-current assets, investment will be shown in the first year as 5,100, in the second year as 5,212, in the third year as 5,337. So this is through amortized cost treatment in the statement of profit or loss and SOFP for the financial asset. So it's the same, only except writing as finance cost, we are now taking it as investment income, and on the other hand, instead of taking it as long-term liability, we are taking it as non-current asset. It's our investment. Otherwise, the principles are same. Moreover, in the exam questions, sometimes they will be examining the business model test as well. If they tell you that the purpose of holding the investment is trading, then you are going to adopt fair value through other comprehensive income. And if it's not for trading, then you are going to have it for amortized cost. If nothing is mentioned, then fair value through profit or loss. It's a default way. Have a look at this question. If you're clear, then we are going to move on. Yes, students, clear? Okay, let's start doing next part. Question number 2. Prepare the extracts from the statement of profit or loss for the year ended 31st December 2007 and a statement of financial position as at that date. So only for 1 year we are required to make the statement of profit or loss and SOFP. That is 31st December 2007. And the year starting date is 1st January 2007. A company invested in 10,000 shares of a listed company in November 2007 at a cost of $4.2 per share. At 31st December 2007, the shares have a market value of $4.9. The question over here arises that we are clear that this is an investment, this is a financial asset. But which category we have to adopt? Amortized cost, statement of profit or loss, or statement of other comprehensive income? Is any information being given to you regarding business model test or contractual cash flow obligations? So you are going to adopt default category, that is fair value through statement of profit or loss. So if nothing is being mentioned, you are going to adopt fair value through profit or loss. They have just told you that it is for investment purposes, but they have not given you any other information. So which method you are going to adopt? Fair value through profit or loss. So what we have to do in the case of the fair value through profit or loss, fair value through profit or loss. What we are going to do, as in our SOFP, as a non-current asset, investment will be shown at which amount, students? Tell me. At fair value, is it? At fair value, we have to write our investment in our SOFP. This is predetermined. What is the fair value at 31st December 2007? In November 2007, the cost has been $4.2. But at the year ending date, at 31st December 2007, the market value has become 4.9. So you are going to recognize it at the fair value, market value. What is the market value in 31st December 2007? $4.9. So $4.9 multiplied by 10,000 shares are there. This is the amount at which we are going to recognize our investment in our SOF. That is the fair value. How much it is? 4.9 multiplied by 10,000? Sorry, 49,000. This is the value at which we are going to recognize in SOF. In our SOPL, we have to take investment income as well, which has been a gain or loss during the period. So how much it is going to be recognized in SOPL? Can you see there is a gain? The cost has been 4.2, but the fair value is 4.9. A gain is there, which has to be taken to the statement of profit or loss as an investment income. Students, it's not amortized cost, so that is why we are not making that table. If it has been amortized cost, then we are supposed to make that table. So if there is fair value through profit or loss, only these calculations we have to do. So how much fair value movement is there? From 4.2 to 4.9? 0.7, is it? So 0.7 increment is there, $0.7 multiplied by 10,000. How much gain is there? 7,000. This is going to be recognized in statement of profit or loss. Since it is a fair value through profit or loss, no other treatment is going to be there. Only this much is going to happen in the case of fair value through profit or loss. Have a look at this part and then we are going to move on. Students, if you see that you have adopted fair value through profit or loss, and if there is a downward revaluation, say for example, the cost has been 4.9 and the fair value was 4.2. This loss is not going to be taken. Okay, this is not going to be taken, only gain. Now, number 3. The requirement of the question: prepare the extracts from the statement of profit or loss and other comprehensive income for the year ended 31st December 2007 and a statement of financial position as at that. So again, for 1 year, we are required to prepare the extracts for SOPL and SOFP. A company invested in 20,000 shares of a listed company in October 2007 at a cost of $3.8 per share. The cost at October 2007 has been $3.8 per share. At 31st December 2007, the shares have a market value of 3.4. Now you can see that at 31st December 2007, there has been downward revaluation. The fair value has dropped down. The company is not planning on selling these shares in the short term. It means that these are held for trading purposes and elects to hold them as fair value through other comprehensive income. So obviously it's for trading purposes. That is why we have to adopt fair value through other comprehensive income, and they have to hold it by themselves as well. So are we going to treat it? Simply in SOFP. In SOFP, we are always going to write the investment, the non-current asset, investment at the fair value. What is the fair value? 3.4. At 31st December 2007, what has been the fair value? 3.4. So 3.4 multiplied by the number of shares, 20,000. How much it is? 20,000 multiplied by 3.4. How much? 68,000. This is 68,000. Together with that, there is a loss as well. We can see clearly there is a loss of 0.4. This loss has to be deducted from the investment reserve. Under the head of equity, we have investment reserve. In SOFP, this treatment is there. Investment reserve. How much loss is there? 0.4. 0.4 multiplied by 20,000. So it is 8,000. 8,000 negative is going to be taken in the investment reserve under the head of equity. This is fair value through other comprehensive income. Together with that, now we have to show in SOPL as well. In SOPL also, in our investment income, there is a loss. How much loss is there? 8,000. This 8,000 loss is going to be recognized there as well. This is statement of other comprehensive income. In statement of other comprehensive income, we have to write. This is the treatment when we are treating the financial instruments, debt instruments in our other comprehensive income. So have a look at all three methods and think that which tests have to be satisfied in order to take the debt instruments in amortized cost and fair value through other comprehensive income. Because for fair value through profit or loss, there are no tests to be satisfied. This is default value. For amortized cost, the financial instruments are not held for trading purposes. For other comprehensive income, the debt instruments are held for trading purposes. And this is how we are going to treat. Quickly have a look at this and then we are going to move forward.
Is that 0.4?
0.4. Hamza, see the difference. It has been 3.8 earlier and now it has dropped to 3.4. So the difference is 0.4. May I erase it, students? Students, in the next lecture, I would like to take the test of IFRS 9. 30 minutes test it would be, but we are going to have a test for it so that we can finish the discussion and revision for this time. Okay. Okay, now students, understanding number 5 is there planned. It is, you can do it from your homes. It's the same one. It's the same one, you can just do it from homes. Now students, we are ending the discussion for financial instruments and we are towards the ending topic, that is derecognition. IFRS 9 tells us about the recognition, measurement and derecognition criteria for the financial instruments. We are towards the end, that is derecognition of the financial instruments. Obviously, financial instruments have to be recognized when the liability or when the asset has arisen. And they have to be recognized once the obligations have been fulfilled, once the asset has been sold off. So we are going to derecognize them as well. Say, for example, take a simple example of receivables. When you are having an authority, having a capacity to receive some amount from the receivables, you record them in your SOFP. When you have received the amount from the receivables, you are going to derecognize them. So simply, financial instruments, whatever category instruments they have to be derecognized from the books of accounts. Derecognition means that they have to be eliminated from our books of accounts. So they say financial instruments should be de-recognized as follows. Financial assets when and only when the contractual right to cash flows from the financial assets expires. So keep in mind the example of receivables. Receivables are also your financial assets. So when the receivables arise, what is an accounting entry? Debit receivables, credit sales. When the receivables pay the amount back to you, debit cash, credit receivables, you do de-recognize them. So financial assets have to be recognized when and only when the contractual rights to the cash flows from the financial assets expire. Financial liability, when and only when the obligation specified in the contract is discharged or cancelled or expires. Simply take an example of payables. When the payables arise, debit purchases, credit payables. When the amount is being paid to the payables, debit, cash, credit payables. You do de-recognize debit payables, credit cash. So you do de-recognize them. On de-recognition, the difference between the carrying amount of the asset or liability and the amount received or paid for it should be included in the profit or loss for the period. So whatever difference is there, you have to take it to your SOPM. Do you remember the discussion regarding irrecoverable debts? When the debts which you were having the capacity to recover were more than the actual debts which you have recovered, the difference is taken as the return of debts, irrecoverable debts in your SOPM. So at the time of de-recognition, you have to see that what your capacity to receive has been there and what you have actually received. The difference has to be taken to the statement of profit or loss, either as gain or a loss. It is not going to be tested in the examination. Okay. Now, factoring of receivables. This is again we are theoretically going to discuss, but in the examination it is never tested. Okay, it is not going to be tested in. Factoring of receivables is a detailed topic in F9, but over here generally I will be telling you what is factoring. Sometimes the receivables are given as a security to the other persons to take the loan on the behalf of those receivables. Say for example, I say to Asif that Asif, I have to take $500 from Rabia. Now I will be receiving that $500 from Rabia after 3 months. You can give me $500 right now. After 3 months, you can take it from Rabia. This is factoring service. Asif will be giving the factoring service to me. Now, the point over here which has to be noted that whether the risks and rewards are being given are transferred to the factor or not. Whether I am, say, for example, to Asif, I say that if, say, for example, in the future, Rabia is not going to pay that 500, that loss is yours. That is not my loss. Obviously, Asif is going to take the few charges to give that services. So once this is going to happening, obviously the conditions are going to be different. On the other hand, Asif can also say that if Rabia is not going to pay me in the future, I will be taking that amount from you, ma'am. So it means that risk and reward is not being transferred. When the risk and reward is being transferred to the factor, it is going to be treated as sale. It is going to be treated as a sale. In the other case, it will be regarded as a liability. So if it's going to be regarded as a liability, it is going to be a financial instrument. If it is going to be regarded as a sale, then no financial instrument. So this is what we are going to tell you over here. Factoring of receivables is where a company transfers its receivables balance to another organization, a factor, for management and collection, and receives an advance on the value of those receivables in return. Accounting for factoring of receivables. Key question. Is the seller in substance receiving a loan on the security of the receivables, or are the receipts an actual sale of those receivable balances? So when is it going to be regarded as a sale? When the risks and rewards are going to be transferred to the factor. If the risks and rewards are still with the person who is having the capacity to actually collect the receivables, this is not a sale. So this is a key question. Factors to consider: who bears the risk of slow payment and irrecoverable debts. A sale of receivables with recourse means that the factor can return any unpaid debts to the business, meaning the business retains the risk of irrecoverable debts. If the risk of the irrecoverable debts is retained within a business, it is known as factoring with recourse. If the risks and rewards are retained by the business who is selling the receivables, who is transferring the receivables actually. meaning that the business retains the risk of irrecoverable debts. In this situation, the transaction is treated as a secure loan against the receivables rather than a sale. So over there, it will be regarded as a financial instrument. In the other case, say IFRS 15, revenue is going to be applied there. A sale of receivables without recourse means the factor bears the risk of irrecoverable debts. In this case, this is usually treated as a sale and the receivables are removed from the entity's financial statements. Once the sale happens, inventory is removed from the books of accounts. Same is going to happen when the receivables are going to be transferred without recourse. Risks and rewards are transferred, they are going to be eliminated, de-recognized immediately at the time of selling the receivables. Now, students, in regards to de-recognition, understanding number 6 is there, which you have to do by yourself. Simple calculations were there, that is why I thought not to discuss it in the classroom. Now, students, disclosure of the financial instruments. The last part of every standard is the disclosure of the financial instruments. Obviously, all the calculations regarding financial instruments, which kind of financial instrument it has been, which category we have adopted in order to measure the financial instrument, how are we de-recognizing it, what is the redemption date, all that note, all that detail will be found in the notes to the financial statements. All of that information has to be disclosed in the notes to the financial statements rather than giving this information on the face of the financial statements. So they say IFRS 7, because IFRS 7 deals with the disclosure of financial instruments. IFRS 9 deals with the recognition and measurement of the financial instruments. IFRS 7 deals with the disclosure of financial instruments. IFRS 7 provides the disclosure requirements for financial instruments. The major elements of the disclosure required are the carrying amount of each class of financial instrument should be recorded either on the face of the SOFP or within the notes. An entity must also disclose items of income, expenses, gains and losses for each class of the financial instrument, either in SOPL and other comprehensive income or within the notes. An entity must also make disclosures regarding the nature and extent of the risks faced by the entity. This must cover the entity's exposure to risk, management objectives, and policies for managing those risks and any changes in the yield. So students, in disclosures, every time the ways of measuring the particular item which you have shown in the SOPL or SOFP is going to be shown. The accounting policies and the methods to reach at the particular amount are going to be shown. Now, students, we have ended this chapter and now we are going to do 2 practice questions, understanding number 7 and understanding number 8. I think we would be able to do only understanding number 7 as it's a detailed understanding. In this understanding number 7, we have actually a trial balance, and from that trial balance, we are going to prepare the SOPL and SOF. So in this question, not only the financial instrument is being revised, but the previous standards are also being revised. So we are going to do this so that previous standards could also be revised to a little extent. Not all of the standards, but IS 16 will be analyzed at any cost. It is never going to be eliminated from all the questions. Detailed questions of the book also is having IS 16 all the times. So from the book, we are going to open understanding number 7 as it was not possible to cover it in the slide. So let me stop this here. I will be opening the book now. Yes, students, here it is, understanding number 7. Yes. Understanding number 7 is there. Let me just share it. As usual, we are going to read the requirement of the question first. Prepare the statement of profit or loss and other comprehensive income of JK for the year ended 30th September 2007 and a financial position as at that date. So we are immediately going to prepare the format. What we are required to do, we are required to prepare SOFP and SOPL. So the name of the company is JK, statement of profit or loss and other comprehensive income for the year ended 31st December 30th September 2007. We are going to make two columns. And on the other hand, we are required to prepare statement of financial position as well. So JK statement of financial position as at 30th September 2007. Now, you are going to adopt the same approach in your exam question as well. Do make both the statements at the same time. Start making them at the same time, students. In your examination, obviously, you will be having Excel spreadsheet on which you have to perform the calculations. So over there, it becomes more easy. Your calculations will not be messy. So whatever you are going to see in the trial balance, write it immediately in both the statements. So you should not be wasting your time. Let's read the trial balance, financial assets and liabilities. The following trial balance relates to JK at 30th September 2007. Ordinary share capital, $1 shares. It is going to be recorded in equity. We start our SOFP by writing non-current assets. But here we have faced equity. I am going to divide our SOFP in two portions. So I will be writing equity over those statements. Under the head of equity, ordinary share capital is how much? It is 100,000. So 100,000 is going to be written over here. Then we have share premium. Share premium as a reserve will also be written here. How much share premium is there? 30,000. We are going to write it here. 30,000. Then we have revaluation surplus. How much revaluation surplus is there? 145,000. Then we have retained earning reserve at 1st October 2006. It's a retained earning at the start of the year. So we are going to do the adjustment over here. Those in which we are going to do the adjustment, I will be writing them in. So retained earning at the start of the year is how much? It is 285,611. 285,611. The net profit has to be added over here. If there are any dividends, we are going to deduct them out of it. Okay, so we are going to come back to it. Then we have 6% loan notes. Loan notes are non-current liabilities. They have to be written in our non-current liabilities. So basically, after equity, we have to write the liabilities also. Okay, so we are going to write liabilities over here. Under liabilities, we have non-current liabilities first. Under non-current liabilities, 6% loan notes. Since we have to make an adjustment in them, as you can see with their name, they have mentioned note 3. It means adjustment number 3 is related to this particular loan. So we can write in exam also, you can write note number 3 over here. Okay, so note number 3 because you are going to come back to it. 6% loan note, how much it is? 74,389. 74,389 is there, but this value can be changed. Then we have 5% convertible loan notes. Again, adjustment is there. 5% convertible. These are convertible. Financial instrument is being applied. Convertible loan note is there. How much amount is there? It is 100,000. And note number 4 applies to it. It is 100,000. Then students, we have revenue. Revenue has its place in SOPL. Revenue is going to be written here. How much revenue is there? It's 565,000. 565,000. We can change the figures later, but up till now, there is no adjustment being seen in the revenue. If there is return inwards, then we have to deduct them out of it. Anyhow, cost of sales are there. We are going to deduct cost of sales over here. It is 339,000. Usually in cost of sales, there are adjustments. In examination, you will be writing the final figure over here, but over here, because we are just in the classroom, I will be writing the figure over here and we are going to make adjustments. So it is 339. Then we have distribution cost. After calculating gross profit, students, the place of the distribution cost is there. Am I right? Distribution cost, how much it is? 53730. 53730. We can make a star over here that the adjustment would be here. Okay, then we have administrative expenses. Just below distribution expenses, we have the place for administrative expenses also. How much these are? 44810. 44810. Then we have 6% non-note interest paid. After calculating profit before interest and tax, we have a place for the finance cost. Finance cost, interest paid is there and non-note interest paid is there. Do they both go in the statement of profit or loss? Who is going to tell? Are we going to write both of these in statement of profit or loss as a final figure? In financial liabilities, which kind of interest I have told you to write in SOPL? Effective rate of interest, not the interest paid. Do we ever write interest paid in our SOPL? In all the discussion of financial liabilities, I have told you again and again, we are going to write the effective rate of interest. If you do remember F3, your teachers over there tell you that write this interest paid and then make an adjustment to it. That adjustment is basically because of the inclusion of effective rate of interest. So this you have to keep in. This interest will not be going to the SOPL, but effective rate of interest will be. So in the finance cost, we have to make the adjustment. We are going to calculate the effective rate of interest, and that has to be written. So these two figures will be used in the calculations. Then we have income tax, note 6. Which kind of tax it is, and where we are supposed to write it. In our last lecture also I told you this. Where we have to write this income tax. Will it be going to one place or two places? In SOFP and in SOPL both, or only in one financial statement? In both? Write it somewhere, right now on your book. Whatever things are in your trial balance will go only at one place. Whichever things are in your trial balance will go only in one place, either in SOPL or in SOFP. Write one more point. The tax which you are going to see over here in trial balance is either an under provision or the over provision of income tax. We are going to discuss this in IS 12. Income tax is yet to be discussed, but this point is already being discussed in F2. So you should be knowing it. The tax which you are going to find in your trial balance is not the current year estimation of the tax. It's either an over provision or the under provision of the tax. Clear? Which kind of provision it is? If it's written on the debit side, it's an under provision. If it's written on the credit side, it's over provision. If it's an over provision, it is going to reduce your tax liability for the year. If it's an under provision, it is going to increase your tax liability for the year. Clear? So please write these important points somewhere. In the last lecture, I have told you also. Anyhow, after writing finance cost, we reach at profit before tax, and then the tax expense just comes. Because it's an over provision, it is going to reduce the tax liability for the year. So whatever tax liability is there, we are going to reduce to 150. So we are going to come back to it. This is an adjustment which we have to see in the notes. Every time the tax liability for the year will be shown to you in your notes to the financials. Whatever you find in the notes to the financial statements will be having two adjustments. Whatever you are going to find in trial balance will be having one adjustment. Clear? Now let's move on. Then we have inventory at 30th September 2007. Which inventory is opening or closing inventory? Closing inventory, because it is at 30th September 2007. Closing inventory does go at two places, in cost of sales and in SOF. But if closing inventory is present in trial balance, it means that in cost of sales it's already been adjusted. It will be going only in the SOFP as your current asset. So since it is present in your trial balance, note 1 is related to it. We are going to see what is that. But anyhow, it will be going to the SOFP only. So current asset under SOFP, we are going to write inventory. How much inventory is there? It is 64320. 64320. I'm writing it in blue since we have to make an adjustment for that. Which note is related to it? It is note number 1. Anyhow, bank amount 29885 will go under the current assets. How much amount it is having? 29885. Students, I will be taking some extra time because we have to finish this in this. Okay, then we have trade receivables 48670. Again in current assets, trade receivables 48670. 48670. Then we have trade payables. Trade payables are our current liabilities. So current liabilities, trade payables, how much? 69650. Then we have land and buildings. Valuation note number 2. Land and buildings does go in our non-current assets. Non-current assets, land and buildings. They are telling that note number 2 is related to it. So we are going to make an adjustment in it. Anyhow, the value being presented to us is 450,000. Current year depreciation is also going to be deducted out of. Okay, so we are going to leave space for that. Then we have plant and equipment at cost. Plant and equipment. How much plant and equipment is there? Cost 265,585. 265,585. Less accumulated depreciation. Accumulated depreciation, 1st October 2006 is 63400. 63400. We have to deduct current year depreciation also out of it, which we are going to come to know by having a look at the notes. Which note is related to it? Note number. Then we have financial assets. Financial assets, note number 5 is related to them. But where do we write financial assets? Non-current assets. Financial assets are also our non-current assets. Students, it will be messy, but I am going to write it over. Financial assets. These are our non-current assets. Note number 5 is related to them. How much amount is there? 130,000. So we are done with trial balance. In the exam also, you have to adopt the same approach. Now notes we are going to see. Note number 1. Note number 1 is related to inventory. They say included in inventory are some items at their cost of $25 million following damage they had taken place during the year. It is now thought that these items can be sold for $30 million, but only after they have been repaired and repackaged at a cost of $8 million. IS2 is related to inventories. IS2 tells us that the valuation of inventory has to be done at the lower of cost and NRV. So we are going to apply, we can do working number 1. Inventory, IS2, lower of cost and NRV. What has been the cost of the damaged inventory? Is 25 million. Are we dealing in thousands? Yes, we are dealing in thousands. So 25 million, it will be 25,000 because in thousands we are taking. So cost has been 25,000 and it can be sold at 30 million, but after having a repackaging cost of 8 million. So what is NRV? It is going to be 30,000 minus cost of 8,000. So NRV is how much? 22,000. So at which amount we have to recognize it? Lower of cost and NRV, we have to recognize it at 22,000. So are we going to adjust it in our inventory? Inventory we have written as 64320. In 64320, deduct 25,000, add 22,000. This is going to be inventory. How are we going to do that? 64320 minus 25,000. We have deducted this cost and we are going to reinstate it at its NRV. So this is going to be the new value of inventory. Calculate it, let me know. 61320. So we are done with note number 1. We are going to write it in black. How much amount it is? 61320. Done. Clear? So we have applied IS2 over here. This is a usual transaction which is going to be asked during the examination. So you have to do it like this. Now note number 2. Land and buildings were revalued to 450 million. So it's fine. Land and buildings were revalued to 450 million. We have recognized them at 450 million. When we are adopting a revaluation model under IS 16, then we have to write our revalued amount in our SOF. So we did the same. It's okay. Land and buildings were revalued to 450 million, including land 100 million. Land amount is always given to you separately because there is no depreciation on that. So they tell you that including land of 100 million from their previous carrying amount of 375 million on 1st October 2006. Students, the carrying amount before it is land and buildings. The revalued amount is not a recoverable amount, it's revalued amount. Revalued amount is how much? It's 450. The carrying value at the start of the year has been how much? $375 million. 375,000 or 50,000. Okay, so 375 million. The revaluation has already been recorded, but the depreciation for the year has not yet been charged. So they are already also telling you that the revaluation is being recorded, but the depreciation is not yet being recorded. So on the revalued amount, you have to calculate the depreciation as well. Now see next. At 1st October 2006, the buildings had a remaining life of 35 years. Students, how are you going to calculate the revaluation? Depreciation. How much revalued amount is there? First tell me. How much revalued amount is there? How much revalued amount is there? Honestly, you don't know about the revalued amount, the difference between the carrying amount and the fair value. What is the carrying amount? 375. What is the revalued amount? 450. How much revaluation gain is there? How much? 75. 450 minus 375, it is 75. Where do we record the revaluation gain under IS 16? Where? You are not revising. Statement of other comprehensive income. In IS 40, investment property, it is recognized in SOPL. Under IS 16, it will be recognized in SOCI. So first calculation, the revaluation gain. Sorry for my writing, it's revaluation gain. How much? 450,000 minus 375,000. It is 75,000. Where are we going to write it? In statement of other comprehensive income? Just after the calculation of net profit for the year, you do write the unrealized gains. So just below it, it is the place of the statement of other comprehensive income. So revaluation gain is how much? 75,000, which you are going to. Now the depreciation is also not being taken for the revaluation, is it? Because they are telling that the revaluation has already been recorded, but depreciation for the year has not yet been charged. And the remaining life is of 35 years. How much revaluation gain is going to be, how much depreciation will be there, students? Out of 450,000, 100,000 is the land, remaining amount is 350,000. Obviously on land, we are not going to take depreciation. So on 350,000, we are going to take the depreciation for 35 years. So 350,000 divided by 35 years is the current year depreciation for land and buildings. 10,000, yes. The depreciation we are going to take. The revalued amount is how much? It is 450,000 minus the amount of building, land, divided by 35 years. So the current year depreciation for land and buildings is how much? 10,000. It is 10,000. So this 10,000 has to be deducted out of this value. 450,000 minus 10,000. Cleared about this adjustment? So we have recorded the revaluation gain and we have recorded the adjustment over here. Moreover, in revaluation surplus, we are not going to write because it is already being recorded. Okay, they are already telling us that it's been recorded. So yes, we are done with this. This adjustment also, we are going to do. Then they say plant and equipment is to be depreciated at 20% per annum using the reducing balance method. For plant and equipment, they are telling that we have to calculate the depreciation on reducing balance method. So on the reducing balance method, we have to calculate depreciation at carrying amount. So are we going to calculate the depreciation for plant and machinery? Plant and machinery. How much depreciation is going to be charged? What is the carrying value? In SOFP, we have written the cost has been 265,585. 265,585 minus accumulated depreciation has been 634,000. 634,000. This will be the carrying amount. On this, we have to calculate the depreciation of 20%. How much it is? 40437. First, calculate this and then multiply it by 20%. Have you done the same? So it is 40437. This is the current year depreciation which you are doing. 40437. We are done with this. One thing, students, which I have missed over there, depreciation has to be taken to SOPL as well. Okay, so whenever you are doing the question in the examination, think that whatever is in the notes will be having two adjustments. It will be going to SOPL and SOFP both. So we should not be missing depreciation in our SOPL also. So in administrative expenses, we can write it 44810 have been our administrative expenses. The current year depreciation for land and building has been 10,000. And for plant and machinery, it is 40437. So this will, unless it is being specified, you are going to take the depreciation in your administrative expenses. So now these are going to be the total of your administrative. Now, students, question point number 3. Note number 3 is related to 6% loan notes. Here, JK issued its 6% loan notes on 1st October 2004. It is much before to our year-ending date. The 6% loan notes have been issued on 1st October 2004. They were issued at their nominal value of $70 million. They will be repaid at the premium in 2004. The finance department has calculated that the loan note has an effective interest rate of 9%. Students, the value of the loan note as per trial balance was how much? 74389. So it means that the value which we were supposed to take to our SOFP is being calculated already. What we have to do, we have to calculate the effective rate of interest, which has to be taken where? It has to be taken in our SOPL. Students, can I request you to do the calculations for both the note number 3 and note number 4? Because it is related to financial instruments. And tell me the adjustments. Take 2 to 3 minutes and do this quickly. This is at the start of the year. We have to calculate it at the end of the year as well. This is the balance at the start of the year. Here we are supposed to write the balance at the end of the year. Yes, Zoom? Yes, let me. Fine. Yes, how much amount you are going to take to the finance cost in regards to the 6% loan notes? The amounts which are written in the trial balance are the amounts which are at the start of the year. So balance at the start of the year which you are going to take is 74389. In that only you are going to take the calculations. So note number 3, I can do it over here. 6% loan notes. Have calculated that the loan notes as an effective rate of interest at 9%. Okay. So balance at the start has been 74389. Finance cost, which has to be taken to SOPL, is how much? 9% effective rate of interest, and then interest paid. Interest paid in 6% has to be taken from the trial balance. From the trial balance, interest paid is being written. How much it has been? 4,200 if I'm not wrong. Interest paid for these has been here 4,200. Okay, 4,200. It's for the year. It's already been calculated. So 4,200 interest paid will be taken, and here balance at the end of the year. Finance cost, calculate 74389 multiplied by 9%. 6694. 95. Okay, 74389 plus 6695 minus 4,200. 884. Now the 6695 has to be taken to the finance cost. Is it? 6695 has to be taken to the finance cost. This balance at the end of the year has to be taken to the SOM. So instead of 74389, this amount is going to be changed to 76884. This is just the only treatment for this point 3. This is how in the exam they are going to test you. Cleared? So we are done with this. Now note number 5. This is regarding convertible loan. Can you do this? Are you people getting late? Just 10 minutes more. Fine for you? Yes, I'm doing fine. Yes. 4% in which one? 4 point. Yes. Yes. Do the 4. Students, one more thing, the inventory has been written down. The inventory has been written down by 3,000, is it? This 3,000 has to be taken out of the cost of sales as well. The inventory written down. The cost of sales is going to be, it's going to be having an elimination of $3,000. Inventory is being written. Yes, done with 5% convertible loan. First, calculate the present values. You are going to calculate the present value using the discounting factor at 8%. And you are going to see that how much element is regards to equity and how much is in regards to the debt. In regards to note number 4, students, they say on 1st October 2006, just at the start of the year, JK issued 5% convertible loan notes at the par value of $100 million. The loan notes are redeemable at par on 30th September 2010. Why 0 means 10. So it means that September 2007, September 2008, September 2009, and September 2010. 4 years are there. 1, 2, 3, 4. Or maybe converted into 150 ordinary shares for every $100 of loan note. An equivalent loan note without conversion option would have carried an interest rate of 8%. Interest of $5 million has been paid on 30th September 2007. You are going to take 8% for the discounting factor. How many cash flows are going to be there? In the first year, how much cash flow will be there? How much interest is there? 5,000? Answer is 5,000. Cash flow, how have you calculated it? 100,000 is the par value of the loan notes, and the interest rate is 5%. So 100,000 multiplied by 5%, how much it is? 5,000. In the second year also, 5,000. In the third year also, 5,000. In the fourth year, together with the principal amount you have to return. So the principal amount is 100 million, 100,000 plus 5,000. 105,000, is it? 105,000 will be the cash flow at the fourth. Then the discounting factor at 8% we have to apply 0.93, 0.86, 0.79, and 0.73. How much present value is there? 5,000 multiplied by 0.93. 4650. 5,000 multiplied by 0.86. 430. 5,000 into 0.79. 105,000 multiplied by 0.73. 76650. Total it will be an element of debt. 89,550. Total loan has been 100,000. Is it? The remaining portion is belonging to equity. 100,000 minus 89,550. 10450. This is belonging to the equity portion. 10450. Got it? Is everyone clear? So this is the first portion that we have to do. Under here, we have to write this equity as well. Equity from convertible loan. How much it is? 10450. This is not over yet. What we have to do next? We have to calculate the finance cost as well, because finance cost has to be taken to our SOPL also. So are we going to calculate it? Initial value will be taken as 89550. Only for the first year we are going to do, because only on 1st October 2006 the debt has been issued. So we are going to do the same calculations. I'm continuing over here. In the same way, we are going to do it. What we are going to do? Balance at start. Finance cost. Finance cost will be taken at 8%. Interest paid, and then balance at end of the year. How much balance at the start of the year is there? 89550. Finance cost 89550 multiplied by 8%. 7164. How much interest paid we are going to take? Interest paid we have to see from the trial balance. That is the current year interest which is being paid. How much interest for the convertible loan has been there? 5,000. So 5,000 we are going to take as interest paid. And the balance at the end of the year is how much? 89550 plus 7164 minus 5,000. 91714 will be taken over here in the SOFP. 91714. And the interest finance cost 7164 will be taken to finance cost 7164. This is the total finance cost. Clear? So we are done with this one as well. And last adjustment, students. No, second last. The financial assets are held for trading purposes and represent investments in the equity shares of listed companies. These investments are classified as at fair value through profit or loss. At 30th September 2007, the fair value of these investments was estimated to be 150 million. So we are remaining with this. In the trial balance, the amount of the financial assets was written as 130,000. We are dealing with them in the category of fair value through profit or loss. At the end of the year, the fair value has been 150,000. In the SOFP, it has to be written at 150,000. Is it at fair value? And 20,000 upward revaluation has to be taken to the statement of profit or loss as our investment income. The investment income we are going to write over here. Investment income for the financial assets, that is 20,000. Okay, the last adjustment. The balance on the income tax account in the trial balance is an over provision. So they have mentioned it over here as well. Even if they are not mentioning, you have to memorize it that if in the trial balance on the credit side income tax is written, it's an over provision. Arising as a result of the settlement of the previous year's tax charge, the directors have estimated the provision for income tax for the year to 30th September is 24 million. This is the current year income tax liability. So current year income tax liability on one hand, it will be going over here. Income tax for the current year is how much? 24 million, 24,000. We are going to write over here. On the other side, it will be going over here as well. And over there, we have already adjusted over provision from trial balance. So how much it has been? 24,000. Now, students, the net profit, the figure which you are going to get over here, has to be added in your retained earnings at the start of the year. Here, the net profit is going to be added. And this final figure will be written. And then your sum of equity and liabilities must be equal to the total assets. This is all. I hope that you have understood. Now, what you have to do, you have to revise it all at your own also. Otherwise, it will be difficult for you to understand. In our next lecture, we are going to have a look at a very important topic, that is interpretation of the financial statements. I know that up till now we have discussed so many standards and it can become a little bit tedious for you and tiring for you as well. I can understand, I can totally understand. So in our next lecture, we are going to start with little bit interesting topic, that is interpretation of the financial statement. And one question is must out of that. One full-fledged question is expected from the interpretation of the financial statement. So more of the theory is going to be discussed in that, and it will be a little bit different from discussing the ordinary standards. So anyhow, today we have discussed one of the complex standards, IFRS 9. So it is now finished. Yes, dear? Sorry? It was it is chapter number 9. Now, students, 1 to 9 we have finished. I told you that chapter 6 and 7 theoretical you have to do by yourself. In other standards, we have 3 small standards which we are here to discuss. In the next lecture, we are going to discuss this chapter, chapter number 22, interpretation of the financial statements. So our syllabus is probably going to be finished by 15th of May. It is going to be. And I do want all of you to attempt your exams in this June attempt. Do not delay your exams. Do not delay your exams ever. And what I have observed up till now, that you people are not revising the concepts. Telling you very honestly, you are not revising. Asif, I feel that I've been revising more previously, but nowadays he is revising this. Am I wrong? Asif? So, he's telling that I'm wrong? Teacher is always wrong. Okay. So anyhow, please revise the concepts, students. It's for your betterment. Okay. Anyhow, I will not be taking more time. Take care of yourselves. See you in the next one. Okay, online students?
Yes, miss. Bye.
Bye.